You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time once again for the Option Block, a little show we like to think is your favorite bi-weekly source. I know it's certainly my favorite bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, ever-expanding Options Insider Radio Network. 13 programs, hopefully soon to be 14 and maybe even beyond on the old network for you guys to enjoy. Starting off, of course, the easiest place to find all of that content, the mothership, the flagship, theoptionsinsider.com. Click over there. You can either click on the call out right there on the right-hand side of the homepage or on the Insider Radio Network tab, top left corner of the homepage. We made it really easy for you guys to find it. No matter where you like to get your radio, we made it easy for you guys to find it, including, of course, iTunes, TuneIn, Stitcher, so on, so forth. Soon to be, I believe, the Google Play podcast, whenever they turn that feature on. We're all uploaded and ready to go whenever that's ready to go. So soon to be there as well. Even our Amazon Alexa, you can talk to what we have in our studio here. So it's always fun to talk to Alexa and say, Alexa, play me the option block. That's always kind of fun. It feels like you're in the future. It feels like you're riding along on the old Enterprise, telling the computer to do your bidding. It's pretty fun. So check that out if you have one of those as well. And of course, you can always get us on your device of choice via our mobile app, available for iOS, Android, and the ever exciting, ever lovable, ever fun Fire OS, of course. So check it out. And of course, while you're using that app, you can send us your feedback, your questions, your comments. We love to hear from you guys. We are also live once again on Mixlr. I apologize for the sporadic schedule of the live streams. I've been traveling hither and yon a lot lately, and when I'm not in the studio, kind of makes it hard to beam the show out live. But we are live yet again via MixLR. Download the app for your device, or just follow us on Twitter or Facebook or wherever else you follow us, and you'll see the link going out there. You click on it, it'll take us over to the old Mixlr chat room. You guys can join your fellow listeners there, ask questions, share your comments, and just stream the show and have fun. It's always a fun way to do it. So if you guys don't want to mess around with waiting for the edited version, you want to see how the sausage is made live and gritty, well, that's an easy way for you guys to do just that. And I am joined, as always, by my compatriot, my partner in crime, good old Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome back to the Option Block program, sir.
Excited to be here. Let's make some sausage.
Lots of sausage being made today on the old show. We will, of course, be joined by the old Greasy Meatball a little bit later. He's running a little bit late, as usual, but we'll forgive him for that because he doesn't know where the heck he's hanging his head from one day to the next. Some day he's in our studio, some day he's over there out in Riverside, some days he's downtown. He's kind of all over the place. Some days he's in Detroit, scenic and lovely Detroit. So he is hither and yon, and we'll beam him on when we get ready. Meanwhile, it's time for us to get started with the old program and dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. This is indeed, like the name implies, the portion of the program where we break down what was moving, what was shaking, what was rocking, what was rolling in today's market activity. I'm not going to lie to you. Not a heck of a lot. Really kicking it off for this start of the week here towards the end of March. We are recording this for all of you playing along with the home game on Monday, March 28th. Most of the major indices pretty much almost literally, if not exactly, unched at the close here. We saw a little bit of vacillation intraday. Had about a 10 or 11 handle range in the S&Ps out there intraday. Certainly compared to what we've seen of late, it's not exactly lighting the roof off the place here. It's pretty much pretty calm stuff. That said, there were a few spots to cherry pick out here, Uncle Mike. A few spots that were of interest. So perhaps we'll start there. What caught your eye in today's activity, if anything, sir?
Like you said, I don't think there's really a whole lot going on today. We had some interesting intraday moves just in looking through it. We had a nice little pop around 11:30 Chicago time, but we really couldn't get any follow through on it. I thought what was interesting about it is that the pop that we got a little bit after 11:30 took us back to about where we opened at on the day. And I remember watching it during the day. I was thinking, okay, well, maybe this could be the beginning of the rally for today because we've sold off and now we're starting to come back, but no such luck for we bulls. Market just kind of stayed sideways the rest of the day and went down another whopping 3 points by the end of the day on the S&P. So not a lot. If you are a day trader, today would have been a pretty nice day for you. Just with the intraday movement that you had. Most likely it could have been a really bad day for you, I guess, as well. But overall, I have to agree with you. I'm sad to say there's really nothing lighting up my tape right now.
Well, you are our resident bull, our bull in residence. You reside in the bull chair here on the old All-Star panel. Bloomberg had an interesting write-up today, kind of breaking down some of the stats, the metrics on this current bull market we're in, whatever, call it what you will. That's kind of thing you write up when there's not a heck of a lot going on. You look back into the old history book, pull out some metrics. They're saying right now, since the Great Depression, which was back in the old 30s, of course, we've seen 7 bull markets that have witnessed rebounds from periods of lull, and you can certainly call what we've seen over the past few months, I guess lull is one way to describe it. I don't know if lull is really all-encompassing, but euphemistic there, but still a lull could certainly be applied there, that have lasted longer than the current one, sometimes a lot longer. The average gain in the subsequent 12 months, nearly a quarter, nearly 25%. So that's something to keep in mind for all you diehard bulls who are looking for a reason to stay in or to pile back in to the old marketplace. Of course, we have seen a massive surge in the S&P and in the broad markets over the past few weeks. The 5 weeks through last week through March 22nd, we saw the S&P pretty much reverse about a 10% retreat, restore about $2.5 trillion of value back into the marketplace. Even that said, even with all those numbers there in the old record books, are still about 100 handles below that high from last May 21st, which was 2130. We closed today right around 2036, so right around 100 handles south of that. And of course, we always like to dig a little deeper here, dive into such things as volatility and a few other things. And of course, over the last year, the last 12 months, we've seen 1% moves in the S&P 81 times. That's pretty much more than 2013 and 2014 combined. So that's why I kind of have a hard time describing Q1 here of the year as a lull, because from a volatility, from a rocking and rolling perspective, it certainly was a lull. It certainly wasn't a lull, but if you're a bull and you're just kind of playing the Buffett buy and hold game, then yeah, that was a bit of a retreat from the ongoing appreciation in the marketplace. But I don't know, Uncle Mike, can you look back on Q1 and really describe it as a lull?
No, by all means. It was one where BBI was very high very frequently in Q1. But, the thing that I'd want to mention to everybody is that, yes, if you look at it from start to finish, we're pretty much right back where we started on the 1st of January. But in the interim, it's been a roller coaster. And so you need to be prepared for that. You need to have a plan for that. And you need to be set up in a way to where you need to be prepared for a bull market, a bear market, as well as a sideways choppy market for that reason. And sideways and choppy has been the way with which we have been going. It's been very choppy. The fact that we were down almost 10% at one point during the quarter and rebounded from that is quite a big accomplishment, and especially when we started off so in such a down year like we had at the beginning in January. To be back to where we are, it's something else, to say the least.
Speaking of something else, something that is the exact opposite of something else, actually more of the same, but maybe a little bit more definitive stamp on same, is what's been going on in the ongoing back and forth between ISE and CBOE over some patents. You remember there's been a lot of back and forth on patent lawsuits. It's kind of weird to say ISE versus CBOE now because they are parts of the ever-expanding NASDAQ exchange empire. But that said, they do still have legal motions in the works, and we saw the latest developments. If you've been following this saga, and I'd imagine only a handful of you really deeply invested in financial patents have been doing so, there's been back and forth, of course, regarding, ISE launching the spider options, which was the start of this, and then attempting to invalidate SPX, and a lot of back and forth therein, where we saw a recent ruling coming out of the appeals court that kind of upheld a decision from the Patent Trial and Appeal Board, the PTAB, for those of you in the know, essentially that had invalidated 3 CBOE patents. I won't bore you with the patent numbers themselves, but essentially allowing an earlier decision to stand, which is kind of interesting. Interesting also to see what ISE/NASDAQ is going to do with this information now that these patents, the invalidation of them has been affirmed. Is kind of confusing. It's kind of like double negative there. You're affirming a negative, but c'est la vie. That's where we are right now. And we should be joined, I think he's trying to beam in now at the Skype gods will smile on him, by the greasy meatball himself. If he can hit the answer button. He seems to be having challenges, so we'll let him figure that out on his end. He's only been on 500 plus episodes or so of this program, listeners, so it's hard for him to keep figuring these things out. But while we're dialing him, I think, let's see, of course, he cannot answer. It'd be interesting to have him, of course, be the counterpoint to Uncle Mike's diehard bullishness. But that said, it's all going on. Here we go, trying to dial him again. Still, you guys in the live chat room, you get to see again how the sausage is made. We cut out this magic in the edited version. But that said, you guys get to see a few other things kind of catching our eye today. There are a few names. You can't really say it's earnings season anymore. A few names kind of reiterating some weak guidance, like GameStop. They kind of reiterated some weak guidance there, kind of weighing in on their fourth quarter numbers. Pandora also kind of doing surprising executive switcheroo there, not really explaining why they're doing that. That's never really a good sign. So that's kind of weighing on the name a little bit today as well. I mean, you have surprise shuffles in the executive suite without any advance warning, kind of also perhaps a sign that something's afoot. Of course, the streaming market, perhaps a bit challenging one to navigate. A lot of people upset about the royalties they get or don't get through those ways. Certainly nowhere near as robust as it used to be back in the days when we used to buy a CD in the store. And someone who remembers those days very well is the greasy meatball himself, Mr. Mark Sebastian. Mark, are you there, sir? And if so, welcome to the Option Block program. Better late than never.
Yeah, it's great to be here. A little weird dialing action today. But, I'm here. It's good to be here. Good to be live, and happy to see you, Mark.
Well, if you can see me, then you have that spy camera rigged up again, which is what I've always accused you of. But we just did Uncle Mike's rundown. As we kind of admitted at the top of the show, not a heck of a lot, really lighten it up today. But that said, there were a few nuggets. Anything catching your eye in today's activity, sir?
We're going to talk about a couple of interesting trades in the unusual activity, but I think VIX was kind of interesting. People are going to look at the VIX today and say, boy, S&P was up a point and VIX was at 50 cents, but you got to remember we're coming off a long weekend, and VIX actually opened up about $1.20 and then backed off kind of all day. And so I think it kind of priced itself like the upcoming FOMC is going to be the FOM, the M in FOMC, not FOMC, I mean non-farms, pardon me. Kind of pricing itself like non-farms are going to be a little bit of meh. And they may be the meh non-farm payrolls that we've seen in some time.
I believe the word you're searching for, the term you're searching for, is a resounding meh. Which is exactly what the market appears to be pricing in. And since you're alluding to the odd block, let's just get right to it and dive right on into the aforementioned odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
All right, everybody, welcome to the Odd Block, the portion of the show where we break down some of the interesting, intriguing, weird, wild, head-scratching, downright whimsical paper that is lighting up in the old options market today. We are, of course, talking good old VIX itself. Yes, the old Volatility Index, a.k.a. the fair gauge, a.k.a. the implied vol of the S&P 500 options. The VIX, as we neglected to mention at the top of the show, at least the old VIX cash, getting a little bit of an inhale coming off of the long holiday weekend, as it is wont to do in a lot of these scenarios. They take a ton of juice out going into the long weekend. They get maybe a little bit overzealous, and then they kind of put a little bit back in. And today was pretty much a little bit of a mildly frothy day, so makes a lot of sense out there. Of course, the VIX cash at about 15.25 isn't what caught our eye today. It was actually the options paper that went up around it. Actually, overall, was a pretty mild day for the VIX. This name has been averaging about 600,000 contracts and change a day. Today, doing about half of that, doing about 360,000 contracts. So a really anemic day for VIX. You know, any other name on the planet, that would be a rock star day. But for VIX, that's kind of just a weekday, showing kind of how little was going on. That said, we did catch a few interesting trades. Uncle Mike, you'll probably like these too, because they involve at least legs that are stupid-esque. Starting off here with a straight-up stupid. We had paper coming in selling the May 25 calls for 77 cents, and then the May 28 calls for $1.10. Doing that, obviously, for $1.87. Doing that stupid about 20,000 times out there. So fairly sizable stupid, and a pretty wide one too, 25, 28. A lot of times you don't see them that wide. Usually we'll see them maybe a little bit tighter because they're using them for some other reason. So pretty wide, pretty interesting, stupid. It's almost, well, it's not a strangle because they're still both out of the money, but it's getting wide enough to a few more handles, and maybe we'd start thinking about that. But still just ye old stupid 20,000 times. And that would usually be enough to catch our eye, a 20,000 lot of a stupid. But then, if that is not enough for you there, listeners, we also saw another trader coming in, perhaps related, probably not though, doing 35,000 paper buying of the May 19 calls for $2.40, then turning around and selling 35,000 of our old friend, the May 25s, for $1.10. And then, so one guy selling them for 77 cents, one guy selling them for $1.10. And then 35,000 of the May 28s at 75 cents, doing a bit of a call tree. So it could have been someone maybe upstairs was enticed by that earlier paper and said, actually, I'm going to come in and do it this way. It's kind of odd that both strikes were in play at the same time on the same day, and both for size. Again, maybe that first trade going up, perhaps sparking a little bit of interest from some upstairs players, and they came in and said, actually, we want to do this vertical / tree actually on this other kind. Either way, pretty weird. Let's see if we got the greasy meatball back first, and then we can dive into some more of this fun stuff. Mr. Greasy Meatball, are you there, sir?
You know, it was an interesting trade that we saw, and I wasn't sure whether that stupid was a front run or whether that stupid was just two different guys with the same idea. But one appeared to be an income play, and the other one was absolutely a hedge. So, you know, two different coins, similar trades with I think, two different intents, and I think that's what made the big difference.
Yeah, it is. I'm not a big believer in coincidence, and it is kind of odd to see two going up for such big size on such identical strikes here. I kind of lean, maybe it could have been a front run. I didn't put the malicious angle in there. I thought more of the inspirational angle, someone being inspired by that early trade. But it wouldn't be the first time we saw a trade get excessively shopped, and perhaps someone coming in to try to front run it. Again, the danger of information leakage out there in a product like VIX. Uncle Mike, I know you're a fan of a stupid or two. What's your take on these exceedingly wide stupids in one, and the other kind of being more of a tree, but still having a stupid-esque element? Don't get to talk about a lot of stupids in VIX, so that in and of itself is worthy of note.
Oh, it made my day to see a stupid in the VIX. Now, and just to clarify, I have a very specific stupid that I only like to do on occasion, but I am not an all type of stupid person. In looking at, the only other thing that I could add that you guys did not talk about is that I think that perhaps there's some fund manager out there to where it's the big money that's not necessarily the smart money, and someone said to a fund manager that may or may not have anything to do with options ever, or maybe might do some covered calls occasionally, and someone might have read an article on, oh, you can actually trade options on the VIX itself. Oh, okay. Well, let's sell some options on that, because it's gonna, if we're in this case short volatility in the VIX, then by doing something like this, then just sell some of these calls here. Just sell a bunch of these. Okay. Then so he goes back to him and says, you know what? Why don't you sell some more? Well, should I sell the same call again? No. Sell another one. Sell another one. We don't want it to be the same thing. Let's diversify. The only other thing that I could think of is that there was a conversation like that being played out in some type of a large fund manager's office who doesn't really have a lot of experience trading options on the VIX.
That one might make some sense. What I do know is this came in as two very separate trades. Because if you just looked on the screen, you would have thought the guy did like a ratio stupid so he could do the whole thing for a credit. But that was not the case. These were two distinct trades, came from two different houses. So unless the guy was just kind of covering up himself so that it looked like two different things, although that would seem, these trades are so similar. It's not like, he saved himself 2 cents on 17,000 contracts. That's for that kind of size, that's not a huge deal. But yeah, Mike, that it might be an income play. Using VIX in replacement of like a covered call does make some sense. So it absolutely could be that. So I hadn't even thought about that.
And we'll get to a listener mail about not using VIX to do that, but using options as a surrogate for some covered calls and long underlying in a little bit. But first, let's keep rolling with the old odd block back out of the land of VIX, out of the land of the fear gauge, into the realm of China, perhaps its own fear empire these days out there. In particular, the FTSE China 25 Index ETF, ticker symbol FXI, closing today right about 33 even. Up nearly 1%, or about 20 odd cents on the day. This is the name that does about 100,000 contracts a day. So a robust name here in the old odd block. Got VIX and FXI back to back, putting some numbers up in the old odd block today. Today only doing a paltry 75,000. So a light day out here in FXI. Again, that would be killer numbers for most names that we talk about here. And of that 75,000, a whopping 30 came in one a little bit more straightforward trade this time. Not as much with the strangles / stupid / trees, but instead with a straight up call, buy / gobble. And in particular, it was the AUG 36 halves that caught the attention of our friend out here, scooping up 25,000 just in one block, paying about 69 cents across the board, and then coming in for another 5,000 at similar prices, a total of about 30,000 and change again on this strike. So nearly half of today's ADV going up in this one massive call palooza. It's opening. How do we know that? Well, only 71 contracts open on that strike. So that's kind of how we know we can do that math here in our heads really quickly. And again, we looked around, didn't see any other tells with this, didn't see any underlying going up with this or anything else along the lines that would make us think this is anything other than it appears to be on the surface, which is a massive bullish play here on good old FXI. If you've been following this name, you know these have kind of been, surprise, rough road here for FXI over the better part of the last 6 months or so. If you go back to last summer, getting close to about 9 months or so into like June and July timeframe, this thing was trading, pushing the 50 handle, about 48, 49. So this thing at 33 right now, 16 handles off where it was not that long ago. So when you see it in that perspective, this 36 half level by August, it's not the craziest trade we've seen in a long time. It certainly is a swing for the fences. It certainly is optimistic. It's a sizable bet that China's going to right its ship sometime soon, which a lot of people may be on the other side of. But that said, it doesn't seem to have any other moving parts here that we could uncover. Mr. Greasy Meatball, what's your take here on our friend just taking them all down on the upside here on FXI?
Yeah, I mean, this was straight up. Didn't even do it with deltas. Nothing tied up, just straight up, I'm going to buy a bunch of calls. And you know what? He did. And now he's looking for FXI to go up, unless it was some short hedge, but the duration is too far for this to be a kind of short cover type trade, in my opinion. So I think it almost has to be a straight up bull play.
Yeah, you don't often see people worried about a near-term pop going all the way out to AUG. It could be. We've seen stranger things here, hence the name The Odd Block. But yeah, I tend to concur that I don't think this is someone scared of a near-term pop and is short the earth and just hedging the upside. Stranger things have happened, but I tend to concur on that one. I don't think that is indeed the case. Let's move on now to our final name / victim of the day. This is getting back into strangle territory. This is Pinnacle Foods Inc., ticker symbol PF, closing today $44.74, up about a quarter or a little more than 0.5%. And this is getting back into good old odd block numbers here. This is the name that does 349 contracts a day. So this is more along the lines of what we're talking about. Forget those VIX with 600,000 contracts a day and others with 100,000 contracts a day. Give us these nice 300 contract a day names. This is where the odd block bread and butter was built. And this name doing a little bit more than 349 contracts, doing about 4,256. And of that, what caught our eye? Well, a bit of a funky one. It was the June 40-50 strangle going up. Paper, looks like paper selling about 2,000 times each. So 2,000 of the June 40 puts, 2,000 of the June 50 calls, doing it for 52 cents on the put and 67 cents on the call. Doesn't look like anything else went up with this trade. No stock, no nothing. And looking at the strikes, both of them appear to be opening about 600 some odd open on the 40 puts and about 2,000 open on the 50 calls. As the strangle indicates, this is pretty much a friend of ours here betting that this name ain't going anywhere soon, at least not beyond the 40 to 50 range by June expiration. He's putting his money where his mouth is, to the tune of about 2,000 or so contracts. This is an interesting name, pulling up a chart of good old Pinnacle back over the past year. This thing has been fairly range bound for the better part of the last year. It's pretty much been from about the mid to high 40s. It flirted with 48 ever so briefly back last year. And on the low end, it has broken through 40 a few times, as recently as back in February, getting down to about 39.5. So he is flirting with danger on both ends, but he's not really too extreme. And he's clearly saying, hey, if it breaks the 40 handle, not a bad level. I don't mind picking this thing up here. Mr. Greasy Meatball, if the Skype gods are smiling on you, take us home, sir. What's your take on our friend here, putting a few lines in the sand here in Pinnacle Foods?
I think it's just a straight premium sale. I mean, that's all it is. I mean, maybe it's one of those screwy sell, strangle, own stock things that I fail to understand, but people seem to love. I'm going to go long stock, then I'm going to sell an out of the money put and an out of the money call for income. Where I'm from, that's called the Texas hedge, but sure. Unless it's that, it's a straight income play.
Not a fan of the old covered strangle, eh?
It's not a covered strangle. What it is a strangle and long a bunch of stock.
I knew that would rile you up. Second I said that. That's going to be the tweet.
Strangle.
That's going to be the tweet from the show.
It's not. It is a covered call and a covered call and a synthetic covered call. Or if you want, it's a short put and a synthetic short put. Either way, there is nothing covered about any of it.
I don't know if anyone told you, Mark, but if you like to sell one put, you're going to love to sell two. And hence all the love for the I'm going to call it that just to turn the knife a little bit. The synthetic covered strangle coming to an option block near you. And since we're talking strategies, let's dive right on into it. It's Monday, it means it's time for Uncle Mike to take the reins and time for us to dive right on into the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the Strategy Block.
All right, Uncle Mike, that's your cue, sir, to take the reins and take our listeners onto a voyage, a journey, an adventure, if you will, into the realm of options, wit, and or wisdom, perhaps a slice of strategery and some analysis and some education thrown in there as well. So where does our strategy block adventure take us today, sir? The floor is yours.
I was thinking about the option pit endorsed philosophy and how it's always better to do a credit spread over a debit spread. Because I like to get money put into my account instead of having money taken out of the account. What do you think of that one?
That's fantastic.
Oh my gosh. Unbelievable. It's just piling on Seabass. I make one off-color joke and everybody piles on.
I couldn't resist. I am sorry. All right. So all joking aside, folks, full disclaimer on this one. We're trying to drive Mark Sebastian nuts today. So with that, in terms of doing a credit spread versus a debit spread, I'll just do a quick mini strategy block before the real strategy block on it. It's pretty much the same thing. So whenever anyone says, I like doing a credit spread over a debit spread because you get money in your account right away for it and you don't have to pay for it, run, don't walk to the nearest exit with your wallet tightly gripped in hand. Now, with that being said, what I want to go through is just kind of talk about a diagonal covered call or a diagonal call spread today. Right now in a market like this, to where it feels like it's not really going anywhere, even though it's come a long way, so to speak. And maybe you want to do like a covered call, but either you don't have the cash to do buying the stock, or maybe you want to leverage a little bit, or you want to be a little bit more conservative with it. It's a strategy with which it's something you may want to consider should the market be right for you. Now, step one with a diagonal call spread, well, I guess even before step one, allow me to talk about or to explain what I'm talking about. What I'm referring to here is instead of buying the stock, you can buy a leap option, or maybe an option maybe 6 to 9 months out, whether it's at the money or in the money. It's your choice depending on how you feel the whatever gives you the best deal, so to speak, for your specific trade. And then selling either 1 week, 1 month, or maybe even 2 month options against it as a way of kind of getting a little bit of income or financing the time decay in it in the long option with which you bought. Now, step one for a strategy like this, whenever I'm looking at it, I believe you need to have low implied volatility. If implied volatility is higher, then I don't think this is a good strategy to do. But if implied volatility is lower, then I think it's something that made sense. It would make sense. Now, what is lower implied volatility? What I want to emphasize on that is, does that mean if the VIX is below 15, it's low, or if it's above 15, it's high, or how does that work? Well, it's up to you. Just to reemphasize a point that the Viceroy nailed down in my head, gosh, almost 10 years ago, implied volatility is only high if you believe it's high, and implied volatility is low only if you believe it's low. Same thing with the stock. Some people believe that Apple's really low right now because it's around the 100 level. It has a 52-week high at the 134 level, and people think that if it's low, it's going to go up. Or some people feel that Apple's really high right now because of the fact that it's going to go down to $60 a share, in their opinion. So with that being said, whether a stock is high or low is somebody's opinion. The same holds true to implied volatility, whether the VIX is high or the VIX is low, or implied volatility on your individual underlying is high or low. That is your opinion. So don't let the prognosticators say, oh, the VIX is really high right now, or oh, the VIX is really low right now. It may or may not be true. What's your opinion on whether volatility is high or low right now? So let's say that volatility is low as defined by your own personal set of trading rules. Should that be the case, then that could be an opportunity with which to do a diagonal call spread with which I described. By buying a call 6 to 9 months out, you do have time decay with which you need to be concerned. Every day, the option is going to become less and less valuable, theoretically, based upon time decay. Now, with that being said, sometimes volatility, vega, can trump theta, meaning that if volatility goes higher, you could actually gain more extrinsic value within the option over the course of the next 4 weeks because of the fact that volatility would go higher. So with that being said, let's just look at step one of this process of just buying the long option. If volatility is low, which once again, you believe it's low, then volatility theoretically will go higher if you're right. Within that long call option, volatility, vega, could help offset the time decay that's going to work against you no matter what. So with that being said, that's reason number one as to why you would look for lower implied volatility when doing such a strategy. Now, the next part of this strategy is you're selling a call against the long call. Now, with this being said, every month you can expect to get a certain amount of premium. And when I say you can expect to get a certain amount, that certain amount is going to be totally uncertain. Once again, my point to the matter is that don't plan on getting the same amount of premium month in, month out. Oh, I got $1 for this 86 call that I sold last month. How come I'm only getting 40 cents for it this coming month? Well, implied volatility's come down. That's why. So with that being said, understand the fact that if you're doing a 6 to 9 month option, and let's say maybe you're selling weeklies against it, week in, week out, or monthlies every month, if you're doing such a thing, you need to have the understanding that the second month of this strategy, assuming the first month you either got out for a profit on your short call or the option expired worthless, whatever way you want to play it, the second month, you're hoping that you can get the same premium or possibly more. Once again, it goes back to the much needed part of the equation for it to be a plausible strategy, in my opinion, and that's with implied volatility needing to be lower. If implied volatility is going higher, meaning it was low and it's going higher, then the following month, you got $1 for that out of the money call the first month. Maybe the second month you can get $1.30 for it. Same strike price if implied volatility in general is going higher. So with that, we've already determined, let's say in this fantasy land trade, that we believe implied volatility is lower. The second part of it is that you need to have the belief that the stock's not going to go up too quickly, because if it does, then you'll make a little bit of money on it, but you need to get out of it pretty much when the short call goes in the money. And with that, there's nothing wrong with that. You will be profitable on it. What I like to do in a situation like that, if it goes up too quickly, just get out, move on to something else. Now, there's adjustments with which you can make on that. Maybe you want to roll up the call, the short call. Maybe you want to roll up the long call a little bit as well. Just depends on the situation of the trade. But the point is that you don't want to necessarily try for a stock that's going to go from, say, 86 to 120. If that's the case, just buy some calls on the darn thing. You'll be a lot better off if you're trying to do that. But for a diagonal spread, you're looking at a stock that'll go maybe from 86 to 88 over the time frame of your short call expiration. And at that stage, you're pretty close to either rolling the call up to where it's not going to be that much of a loss on the short call, but still a nice gain on the long call, or you could still be profitable on the short call, even with the stock going higher because so much time decay has come out of it. So that's another way with which to view this. Now, the final thing that I want to emphasize about doing a diagonal spread is don't let it go too far in the money. Because oftentimes what I've seen people do through the years is they'll kind of do nothing and think of it more like a covered call and think, oh, I'll just let it get called out and not do anything with it. That's a big mistake. The reason is that you still have extrinsic value in that long call. And if that diagonal spread goes too far in the money, you're eventually going to make what was a bullish trade into a bearish trade, because you're going to need the stock to come down a little bit so you don't get burned on all your extrinsic value within the long call. So what I'd want to emphasize with doing a diagonal spread would be, once again, look for something where you have lower implied volatility. Implied volatility, whether it's high or low, is determined by you, not someone on TV saying, oh, volatility's low right now. It's not like looking at a temperature gauge. If I were to look at a temperature gauge right now in St. Charles, Illinois, oh, it's 85 degrees and sunny blue skies, like it is every day, of course. Okay, that was a bald-faced lie, but volatility doesn't work that way. It's your opinion whether volatility is high or low. Second part of it, don't look for a stock that's going to go up too high too quickly, because a diagonal spread is not the correct strategy if that's what your sentiment on the stock is. And then third, don't let it go too far in the money. You don't want to be right on a stock, but then wrong on a strategy, because if you do that, well, quite frankly, you just need to listen to this show a lot more often. So with that being said, that is today's strategy from St. Charles.
Uncle Mike, I think you took a quick gander into the mailbag, because your strategy block was very timely. So without further ado, let's keep on rolling. It's Monday. We don't usually do this. We got a little bit of time, kind of a quiet day. So take advantage of that to answer a few more of your questions with the old mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody. Like the name implies, this is the Mail Block, the portion of the show where you guys get to send it in, but we don't just read your email. We'll also read your Facebook comments. We're just the Options Insider on Facebook. We'll read your tweets, twitter.com/options. We'll even go so far as to read your stock tweets if you'd like to use that platform instead, or of course hit us up via the website, theoptionsinsider.com. Leave a comment there, or of course use our website feedback form. A lot of you like to do that. And of course, the old-fashioned way, as the name implies, questions at theoptionsinsider.com. And if you have a hard time remembering all of that, most of that is baked into the mobile app depending on your platform of choice, so you should be able to hit all of it via the app as well. So we make it as easy as possible for you guys. We've even added the wrinkle of the live chat room here. So if you guys are in the Mixlr chat room and you want to ask some questions or give us some comments, go ahead, feel free. We open it up to you guys as well. Let's kick things off. Since Uncle Mike did read the cheat sheet for today with our listener mail, let's start off with a question here from Mike G, which is right up Uncle Mike's wheelhouse. He just spent about 10 minutes talking about it, or 8 minutes talking about it. He says, hello, Mike here. My father got me into selling covered calls by keeping me interested in his trading as a child. Well, your father is, and you have an excellent father there, Mike. He goes on to write, recently I started learning about other strategies and started listening to programs on the Options Insider Radio Network. Thanks. Well, you're welcome. I recently convinced my father to use collars as opposed to simple covered calls, and I am starting to use long, deep in the money leaps instead of stock to cover my calls. He's learning, Uncle Mike. He's been listening to the shows. He goes on to say, I have two questions. Given that I can use calls to cover my calls, is there any benefit to owning the underlying? Thanks a lot. Well, actually, that's one question, Mike. I would have given you two, but you only went for one. Uncle Mike just did an in-depth review of this, so see the aforementioned strategy block. Of course, there's a number of benefits that he just alluded to when you're doing this. This is why this is one of my favorite strategies. It has different names. I just call it pretty much the long-term stock replacement with the covered call kicker. You can call it whatever you want. I know our buddy over there, Brian Overby, has been on the show a few times, does his Options Playbook Radio. He likes to I think he's trying to call this, trying to coin this, the fig leaf. He has some weird rationale for why it's a fig leaf. I forgot exactly why that is. But there's a lot of different people vying for the title of this strategy. Call it what you will. It is a great strategy because, as you've discovered, most of the Greeks are in your favor, particularly in those adverse scenarios where the underlying starts to move against you. That's when it's nice not to have that Delta One product like a stock riding all the way to the downside. And of course, you've discovered you can cover your calls with that. The one drawback, if you can call it that, to doing this over the long terms, you have to remember when you're swapping calls in for the stock, you're getting favorable, capital and margin treatment. You're going to get better probably than that 50% you could do buying the stock. The flip side of that is that you don't get the dividends. So if you're in some hefty dividend-paying name, then you may want to think twice about this strategy, or at the very least, maybe rotate in some stock around the X date so you can capture some of those dividends yourself, or do some of the other dividend capture strategies we've talked about on this network in the past. That's pretty much the one long-term caveat if you're going to do this in your IRA for the next decade or two. You're going to miss out on some dividends. So bear that in mind. If you're trading a lot of names right now that aren't really dividend heavy and you're doing this to kind of create your own dividend income stream anyway, then you're all set. You don't really need to worry about that component, but that's pretty much the main drawback that you kind of have to keep in mind. Uncle Mike, you just went through a bunch of this. Any other drawbacks you can think of for this strategy over the long term?
Oh, this is one I could literally talk for 6 hours on. So let me go through just a couple things, and I'll try and get it done within a couple minutes. If the stock were to go down all the way to zero, let's say in theory, the stock's at 50, and instead of buying the stock, you're going to buy maybe a 42 call or something like that and do it that way. Yes, technically you have less risk on the table, but the first thing that I'd like to go through with you, Mike, is the fact that don't over leverage yourself. So let's say that normally you'd put $5,000 aside to get into the stock. So you want to just be more cautious and then only have like maybe $1,000 at risk because you're going to do this diagonal spread trade all in an IRA. So let's say that there's no tax implications to it whatsoever. The thing that I would emphasize, Mike, is that don't say, instead of buying 100 shares of stock, I can do this exact same thing with 5 call options instead, and I got a lot of leverage. Be careful with that. Not that leverage is necessarily a bad thing, but really have an understanding of what the right level of leverage is for your individual investment scenario. That's step one. Step two, or concern number two, would be that if there is a dividend on the stock, I actually like doing these on dividend stocks just because of the fact that that makes the long call so insanely cheap. And so when doing so, I like doing these on stocks that, number one, have low volatility, which a lot of times dividend stocks will have that. Not every time, but a lot of times that they will. But like Mark said, you're not going to get that type of an income on it when that's the case. The other thing that I would add to that, instead of just buying the stock right before the X date, the other thing with which you could do is maybe sell some puts and create some premium that way, because of the fact that the put will have the dividend factored into it in one way, shape, or form. But remember, you have to have the right level of leverage and really have a good understanding of it. So initially, those are probably the main things that I would say that make the most sense with why you would do this strategy over a covered call strategy. The only other thing that I would say in terms of a covered call strategy is, let's say that it's not in an IRA and you plan on holding the stock forever, you're just going to be an active covered call trader with it. Then if that's the case, I think you actually are better off just owning the stock, because of the fact that if you plan on owning the stock forever, Warren Buffett style, and just want to get into and get out of these call options and be a very active covered call, being an active call trader, and just never allow yourself to get called out if you're going to go that route, I think that over time you are better off owning the stock. And if you have a portfolio margin account, you can do it pretty well leveraged, because I believe that if you have a good margin interest rate, and if you're really trying to leverage yourself, you'll probably do better just using the portfolio margin than the long call, if and only if you want to own the stock forever. But I would say for the most part, I typically prefer just doing this diagonal spread or fig leaf or whatever the heck you want to call it over doing covered calls.
I have to come up with my own definitive term for this strategy, because I don't like fig leaf, and obviously I was joking about my ridiculously long title for this. I like your idea of the short put kicker. Obviously that's going to require a little bit of free capital floating around in your IRA, which is probably where you're doing this strategy. A lot of people don't do that. They tend to go full tilts, full maximum utilization. So if you're one of those guys, then maybe a few extra short put kickers isn't for you. That said, I know Mark, we talked about this before. Anything else you want to add here on this strategy? You probably go over this quite a bit with a lot of your mentees and students over there in the land of the pit.
Yeah, I would say why do it that way when you could flip it around and take advantage of the skew and get a credit? My general approach is sell the put, buy the call, and then take delivery when you want to, as opposed to paying all that in the money-ness. So that's always been my approach. I'd rather get paid to be long than have to pay to be long. So putting on the risk reversal to me is, the superior way to get long stock versus really any of those, generally, especially if it's in a marginable account.
So you'd rather go pure bullish risk reversal, take the chance of missing some, near-term medium moves in the underlying for all the capital efficiency. You know I'm a fan of a bullish risk reversal.
Yeah, so buy an out-of-the-money call in the leaps and then sell near-term puts. And then if you take delivery, you can flip the position around. But that would be the way I would kind of consider doing that, because those long-term calls are almost always too cheap. And especially if you think interest rates are going to go up in the next couple of years, then I would then be selling short-term puts. I think that's a really favorable trade. Or do put spreads if you're worried. If you want to collar a position, buy a long-term call and sell near-term credit spreads for to put income in your account.
I love it. Come into the dark side with the rest of us, sir. We got time for one little quick comment here. A lot of people have been writing in asking just what the heck the Viceroy was talking about with his, and when that other person wrote in asking about what Andrew was talking about the butterfly thing, and none of us could remember last week when someone wrote in. Well, that's why I love our audience. They remember for us. This one coming from Facey username. I remember that name because it's hard handle to forget. She has probably, or he has written in previously, and they wrote in saying, hey, I listened to episode 509 today, which is a recent episode where we couldn't figure out, just remember what the heck Andrew had talked about. She writes, the listener question about Viceroy's favorite Andrew Butterfly question is from episode 389. In the mail block, I asked about a fly on expiration date, and Andrew set me straight. Well, thank you for that, Faye. I'm glad someone is paying attention here, because it sure as heck isn't us doing 500 plus episodes here. I pulled it up. You can, of course, find this for yourselves, listener, on the optionsinsider.com or iTunes or TuneIn. Watch out on some of those stores. Sometimes they limit how far back in our archives they go. If you want to go the full archives, probably best place is to go via our app. Of course, we'll have it, as well as the website. Episode 389 is called Fly Adjustments and Dividends. Surprise, surprise. We were talking about adjusting fly. So if you want to go in, get that full rundown of what we were talking about, the thing that Viceroy was so ecstatic about, and several listeners have written in since then about, thanks to Faye, we finally know which episode that was, episode 389. I love our audience. They remember when we do not. All right, now it's time for us to keep on rolling into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. This is the portion of the show when we tell you what we're keeping an eye on for the rest of this week into the weekend. We're back on the heels of, coming off the heels, I should say, of a long holiday weekend. Not a heck of a lot, not a ton. In the near-term radar. There are a few earnings still trickling out if you're in the sheer yoga pants camp, easy for me to say. And then Lululemon coming out on Wednesday, good old Dave & Buster's coming out on Tuesday, Micron, a few others. And, of course, the death watch on BlackBerry continues on Friday. Other than that, not a heck of a lot. We got Yellen continuing to talk up the will they, won't they dance with a speech on Tuesday. And, of course, got some numbers coming out on Friday the 1st, probably the most interesting thing of the week. But that said, let's turn our attention to the greasiest of greasy meatballs. What are you paying attention to for this week, sir?
Well, I think we've got non-farm payrolls on Friday, and I think that's going to be an important number. I think these type of economic statistics people are following again, and I think it's going to be an important one.
This one will have some substance, you're saying, huh?
Yeah, I think you could see the market, if it's going to break up, break up in terms of breaking that kind of 2043 level, it's going to be on this non-farm. The only thing I'm kind of debating is, I think a mediocre number, a slightly bad number, or even a slightly good number, we rally. I think maybe the outlier numbers, really bad or really good, we maybe don't. So mediocre is good. Bad is bad and great is bad. I think that's the way it lines up.
Mediocre is good. That's kind of your motto for life, is it not, sir? As we move on into Uncle Mike, in addition to the number this Friday, what are you paying attention to this week, sir?
Well, so I guess then I'll repeat the sentiments of what my wife said. Then I'm looking for the next best thing. But with that being said, I think that with this Friday, I could still see great being good because I think that I could see it just because of the fact that the Fed did say recently that they're probably only going to raise rates twice during this year. And I don't know if great would necessarily scare the market, so to speak. But aside from that, I think the greasy meatball is spot on.
Yeah, the problem, Mike, is we have these little we've got too many cooks in the kitchen right now. And every Fed governor is more interested in hearing the sound of their own voice than actually doing their job. Really, one thing I think that I've ascertained from the last 2 years is Fed governors should talk to Janet Yellen, and Janet Yellen should talk to the public, and that's about it. Because all the mixed messages, all the craziness coming out of these media-hungry Fed governors is borderline hilarious, and they're a group that's supposed to kind of bring stability to the monetary policy and the economy. And in the last 6 months, they've been really the root cause of a lot of the volatility. What they're doing is inexcusable. And 25 years from now, people are going to lambast this Federal Reserve group as absolutely detrimental to the U.S. economy.
I would agree with muzzling with the rest of the Fed, yes.
I don't think anyone here will disagree with putting a nice muzzle. I like your idea. Only Yellen talks, because you can argue Yellen talks too much as well. So maybe we need just a quarterly visit from the Fed, and that's about it. But we can debate that on another show. That music means it's time for the end of this show, the old option block. Before we go, I should mention, I'd get in trouble if I don't, to remind you guys that our Final Four is here for the Options Broker Madness. So if you haven't played yet, then first off, what the heck are you missing? Secondly, you can still have time to get in and make your votes. Our Final Four, after all of our 16 brokers battle it out, we're down to Interactive Brokers versus Options House on the one hand. Some interesting winners here. And then Trade King versus E-Trade on the other hand. So some favorites dropping off early, some surprises making it all the way to the Final Four. Who's going to win? Well, it's up to you guys. Vote via Twitter, vote via Facebook, vote via email, vote via our website, vote however you feel like voting. As long as it gets to us and we could track it, we will mark down your vote, and then we will tabulate all of those numbers via our voting machine here, and we'll come up with the winners, and also you'll be registered to win some nifty prizes. So do that, and I think you're going to like it. So check it out. Our March Madness comes to an end today and tomorrow. So that is Monday and Tuesday for IBKR versus Options House. Wednesday and Thursday for Trade King versus E-Trade. We'll have a winner next week, so stay tuned for that. In addition to the Options Broker Madness, what is cooking in the land of RCM Wealth Advisors?
It's IRA season, folks. If you have any questions on IRAs, contributions, what you should put where, please contact me immediately. If not sooner, there is not that much time left. 312-212-3531, or send me an email at mtosaw@rcmfs.com.
And last but not least, Mr. Greasy Meatball, what's cooking in the land of the pit?
We got our Calendars and Diagonals webinar on Saturday. Go to optionpit.com/calendars. Use code 25_off, off being all capitals. Take an extra $25 off for Option Insider Radio people.
There you go, listeners. Take advantage of that code if you want to get yourself some learning on in the land of the pit. And on behalf of the Greasy Meatball and Uncle Mike, and even the Viceroy, let's throw him in there because he was invoked today, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, and of course, for also sending your questions in and for streaming live, those of you out there who are so inclined. We'd love to see you guys in there asking questions and just generally floating around the chat room. We'd love to see that. And we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.